The notification appears on a Reuters terminal at 9:47 a.m. Beijing time. 7 words that rewrite global finance. China will no longer accept dollars for trade. Not next year, not after negotiations. Starting now, this is a simulation, but the trade volumes, real, the currency mechanics, straight from central bank operations, the $690 billion in annual US-China trade, that's current data. Your mortgage rate, your job stability, the value of every dollar in your bank account, all connected to what just stopped working between the world's 2 largest economies. Most people think the first impact would be consumer prices. They're wrong. The first thing that breaks is something most people don't even know exists. By day 14 of this scenario, a mechanism activates that even the Federal Reserve's contingency plans don't fully account for. It's not the trade that collapses first, it's what happens when the world's reserve currency suddenly isn't required anymore. Somewhere in a bank tower in New York, a Treasury bond trader is staring at a screen showing numbers that shouldn't be possible. Not yet. This is how it begins. Here's the actual mechanism. China currently holds $775 billion in U.S. Treasury bonds and conducts $690 billion in annual trade with the United States. Every transaction, whether it's iPhones shipped to Shanghai or soybeans moving to Guangzhou, is settled in U.S. dollars. This isn't just convention, it's infrastructure. When China announces it will no longer accept dollars, they're not just changing payment preference, they're proposing an alternative, the yuan, backed by a basket of commodities and other currencies. The mechanics are already built. The digital yuan exists. The currency swap agreements with 40 countries are already signed. They've been preparing this infrastructure for 8 years. The first ripple hits before markets even open in New York. A shipping company in Los Angeles has a container of automotive electronics ready to ship to Shenzhen. Value, $4.2 million. They've already been paid by the American manufacturer, but the Chinese buyer sends a message. We can no longer accept dollar payment. Please arrange settlement in yuan or alternative currency. The shipping company doesn't have yuan accounts. Their bank doesn't have immediate yuan liquidity. The container sits on the dock, not because anyone refuses to trade, because the payment mechanism just broke. Here's what most people miss. It's not just new transactions that freeze. Letters of credit, the financial instruments that guarantee payment in international trade, are denominated in dollars. $4 trillion worth of these guarantees are currently active in US-China trade channels. When China stops accepting dollars, those letters of credit become questionable, not worthless, just uncertain. And uncertainty in trade finance is functionally the same as a stop sign. A factory in Tennessee has already manufactured $2.3 million in industrial equipment for a Chinese buyer. The letter of credit says payment is guaranteed in dollars. But if the Chinese buyer can't pay in dollars, and the bank can't convert to yuan fast enough, the equipment doesn't ship. By hour 12, 127 container ships are holding position outside Chinese ports, not because of any prohibition, because the payment settlement mechanisms are being renegotiated in real time. Let's look at the actual numbers. The U.S. exports $151 billion in goods to China annually. Soybeans, aircraft, machinery, semiconductors, medical equipment, another $57 billion in services. Every dollar of that trade just had its payment mechanism disrupted. But here's the deeper layer. American companies operating in China, Apple, Tesla, Boeing, as manufacturing facilities, they're holding revenue in yuan that they normally convert to dollars to repatriate to the U.S. $34 billion in annual profit repatriation. That mechanism now requires renegotiation. This isn't speculation. These are balance sheet realities. The scenario is hypothetical. The corporate structures are real. The mathematics are just arithmetic. Now here's what surprises most economists. The first genuine crisis isn't trade. Companies can adapt payment systems. They can open yuan accounts. They can negotiate alternative currencies. The first crisis is what happens to U.S. Treasury bonds. China holds $775 billion in U.S. government debt. They're the second largest foreign holder after Japan. In this scenario, they make a second announcement 3 hours after the first. Treasury holdings will be liquidated and diversified into alternative reserve assets. A bond trader in Manhattan sees the Bloomberg terminal light up. The yield on 10-year Treasury bonds, the baseline interest rate for virtually everything in the American economy, jumps 0.18% in 4 minutes. That doesn't sound like much, until you understand what it means. Every 0.10% increase in Treasury yields increases the U.S. government's annual interest payments by roughly $32 billion. This 0.18% move, that's $57 billion in additional annual costs. But that's just the federal government. Mortgage rates are priced off Treasury yields. Corporate borrowing rates are priced off Treasury yields. Car loans, student loans, credit cards, all connected to this number. By the close of trading on day one, 30-year mortgage rates have increased from 6.8% to 7.3%. For a $400,000 mortgage, that's an additional $147 per month. For the American housing market, that's a sudden contraction in buying power. The mechanism is clear. The timeline is predictable. What's not predictable? How markets respond when they realize this isn't temporary. And they're about to realize. Day 2. The Federal Reserve holds an emergency meeting. Not scheduled, not announced in advance. They finish at 11:20 a.m. and release a statement. The Fed is monitoring currency market developments and is prepared to ensure orderly market functioning. That language means something specific to market participants. It means the Fed is ready to intervene. They have tools. They can buy Treasury bonds to stabilize prices. They can offer dollar liquidity to banks that need it. But those tools cost money, and they have limits. A currency trader at J.P. Morgan runs a calculation. If China liquidates even half their Treasury holdings over 30 days, the Fed would need to absorb roughly $400 billion in bonds to prevent yields from spiking further. They can do it. But it expands the Fed's balance sheet significantly, and that has its own consequences. By afternoon, 3 American corporations with major Chinese operations make announcements. Apple says iPhone shipments from China will experience temporary delays while payment systems are updated. Tesla says Gigafactory Shanghai production will continue, but financial reporting will be adjusted. Boeing says deliveries of aircraft to Chinese customers are under discussion. The stock market responds predictably. Tech stocks drop 4.2%. Industrial stocks drop 3.7%. Banks drop 2.9%. It's not panic, it's repricing. Every company with Chinese exposure is suddenly worth less because revenue that was certain is now uncertain. But something else is happening that won't appear in news coverage for days. Small businesses are making quiet decisions. A furniture importer in North Carolina has $800,000 in orders pending from Chinese manufacturers. The payment was supposed to settle in dollars. Now it can't. She calls her bank. Can they facilitate yuan payment? They can. But it requires opening new accounts, converting currency at unfavorable rates, and accepting exchange rate risk she never had to consider before. She makes a decision. She cancels the orders. She'll find alternative suppliers. Maybe Vietnam, maybe India, maybe domestic. It costs more, but at least the payment mechanism works. Nobody makes a press release about this, but 40,000 small and medium U.S. businesses are making similar calculations. The aggregate effect is massive. Day 3. China's central bank makes a strategic move. They announce a new lending facility. Any country willing to trade with China and yuan can access favorable credit terms. Not aid, just better interest rates than dollar-based financing. Within 48 hours, 14 countries respond. Brazil, Indonesia, Saudi Arabia, South Africa, Nigeria. These aren't anti-American statements, they're economic pragmatism. If China is the largest trading partner and they're offering better terms in yuan, the math says accept. A Treasury official in Washington watches this develop and understands what it means. The dollar's role as the global reserve currency isn't based on law. It's based on network effects. Everyone uses dollars because everyone uses dollars, but network effects can reverse. If enough countries start using yuan for trade, the gravitational pull shifts, the dollar doesn't collapse, but its monopoly gets challenged in ways that haven't happened since Bretton Woods. Meanwhile, American consumers haven't noticed much yet. Some news coverage, some stock market movement, but grocery stores are still stocked. Gas stations are still operating. Daily life continues. But in logistics networks, the pressure is building. A Walmart distribution center in California is tracking something unusual. Container arrivals from China are down 23% from normal, not because of any prohibition, because payment settlement is taking 16 hours, 8 days instead of 24 hours. Ships are waiting, containers are delayed, the inventory manager runs projections. Current stock levels, sufficient for 18-22 days at normal sales rates. Incoming shipments, uncertain timing. He sends a report up the chain, the response. Monitor closely, prepare contingency plans. Day 5. The first consumer-facing impact appears. It's not empty shelves, it's price increases. A Target in Ohio gets updated pricing from their electronics supplier. Chinese manufactured televisions are increasing 12% in price. Not because manufacturing costs changed, because the payment complexity is getting passed through the supply chain. Laptops, phones, small appliances, toys, anything manufactured in China is getting 8 to 15% more expensive. Not immediately in stores, but in the wholesale pricing that will hit retail in 2 to 3 weeks. A supply chain analyst in Minneapolis does the math. Americans spend roughly $540 billion annually on Chinese manufactured goods. If prices increase an average of 10%, that's $54 billion in additional costs. Spread across all consumers, that's about $400 per household per year. It's not catastrophic, but it's noticeable. Day 6. Currency markets are showing a pattern that concerns central bankers globally. The dollar is weakening against most major currencies, not collapsing, just declining steadily. Down 3.2% against the euro, down 2.8% against the yen, down 4.1% against the Swiss franc. For most Americans, this is invisible, but for anyone who imports goods, it matters. A weaker dollar means imported products cost more. Energy, electronics, food. Anything sourced globally just got more expensive. A small manufacturing company in Michigan celebrates, though. They export industrial equipment. A weaker dollar makes their products more competitive globally. Orders from Europe increase 18% in 1 week. The economic effects aren't uniform. Some sectors benefit, others suffer. But the aggregate impact is disruptive. Day 7. Financial institutions are making a coordinated decision. Major banks, JP Morgan, Bank of America, Citigroup, announced they're expanding yuan trading capabilities. They're not abandoning dollars. They're adding infrastructure. It's a rational business decision. If U.S.-China trade is transitioning to yuan settlement, banks need to facilitate that or lose business. But it's also a signal. The financial system is adapting to a new reality where dollars aren't the only option. A banker in Singapore, where much of Asian currency trading happens, sees something that doesn't make headlines but matters enormously. Yuan trading volume is up 340% in 1 week. Not speculation. Actual trade settlement. Companies are figuring out how to operate in this new environment. The system isn't breaking, it's reconfiguring, and reconfiguration is expensive. Day 8. The cascade reaches American workers. An auto parts manufacturer in Ohio makes an announcement. They're implementing temporary layoffs for 340 workers. Not because of declining orders, because payment settlement delays with Chinese customers are creating cash flow problems. The company is still profitable. But cash flow and profitability are different things. When you can't collect payment for 30 days instead of 3 days, you still have expenses. Payroll, utilities, raw materials. The cash has to come from somewhere. For this company, it comes from reducing headcount. The workers receive notices. They're not being fired. They're being furloughed pending resolution of payment processing issues. The distinction doesn't help much when rent is due. A laid-off worker in Cleveland doesn't connect it to currency policy. He just knows his job disappeared. He starts looking for new work. So do 340 others in the same town. Day 9. Grocery stores start seeing secondary effects. Not from Chinese imports. Most food comes from domestic or closer sources. But from the currency disruption affecting fuel prices and transportation costs. A logistics company that moves goods from ports to distribution centers announces a fuel surcharge increase, 8% on all shipments, because diesel prices have increased due to the weaker dollar affecting oil imports. Every product that moves by truck, which is virtually everything, just got marginally more expensive to transport. A grocery store in Arizona calculates the impact. About 2 to 3% increase in overall costs. They have a choice. Absorb it and reduce profit margins, or pass it through and raise prices. They choose a hybrid. Reduce margins on staples, increase prices on discretionary items. The average shopping cart gets 3-4% more expensive. Most shoppers don't notice explicitly. They just feel like groceries cost more lately. Social media fills with posts. Is it just me, or is everything getting more expensive? The comments confirm it's not just them. Day 11. The bond market is showing stress. Treasury yields haven't stabilized. The 10-year is now at 4.65%, up from 4.28% before the scenario began. That 0.37% increase is costing the federal government roughly $120 billion annually in additional interest. But there's a secondary effect that matters more immediately. Corporate borrowing costs are increasing. A major retailer trying to finance inventory for the holiday season finds their credit line interest rate has increased from 6.2% to 7.1%. They can still borrow, but it's more expensive. So they borrow less, which means they order less inventory, which means manufacturers get fewer orders. The contraction is subtle but real. A CFO in Chicago looks at the numbers and makes a decision: cancel the planned expansion, freeze hiring, conserve cash. It's prudent risk management. But when 5,000 companies make similar decisions, it aggregates into an economic slowdown. Day 13. China's central bank releases data. Yuan usage in international trade has increased 67% since the dollar refusal began. Settlement systems are stabilizing. Payment delays are decreasing. The new infrastructure is working, but it's working for China's benefit. Countries trading with China are adapting. But U.S. companies are facing a choice: adapt to yuan settlement and accept the costs and complexities, or reduce China exposure and find alternative suppliers. Both options are expensive. An executive at a Fortune 500 company with major Chinese operations presents to the board. We have three options. 1. Accept yuan payment and manage currency risk. 2. Reduce China operations and diversify to other countries. 3. Maintain current operations and accept payment delays and uncertainty. The board chooses option 2, not immediately, but over 24 months, they'll shift 40% of Chinese production to Vietnam, Mexico, and India. It costs more upfront, but it reduces exposure to currency risk. This decision is being replicated across hundreds of companies. The scenario isn't forcing them to leave China. It's changing the risk calculus enough that diversification becomes worth the cost. Day 14. The mechanism that nobody planned for activates. Pension funds, university endowments, insurance companies. They all hold substantial Treasury bonds as safe, stable assets. But those bonds are declining in value as yields rise. A pension fund in California calculates their portfolio has declined 6.2% in value in 2 weeks. They're not at risk of collapse, but they're facing difficult conversations with retirees who expected stable returns. The fund manager writes a letter explaining that extraordinary currency market conditions have created temporary volatility. Temporary? Everyone hopes it's temporary, but an actuary at the fund runs different scenarios. If Treasury yields stay elevated, the fund's ability to meet future obligations requires either higher contributions from workers or reduced benefits for retirees. Neither option is politically easy. Multiply this across thousands of pension funds managing $4.5 trillion in assets. And the scenario has created a retirement security challenge that won't manifest for years, but is already locked in. A 34-year-old teacher in Oregon doesn't know this yet. She's decades from retirement. But the currency decision happening now is affecting the security she'll have in 2057. Not everything breaks. A payment processing company in San Francisco sees an opportunity. They build infrastructure for seamless yuan dollar-euro conversion. Businesses can accept payment in any currency, and it's automatically converted at optimized rates. They hire 400 engineers, launch the product in 6 weeks. Within 90 days, they're processing $2 billion in multi-currency trade settlements. They're not solving the crisis, they're making adaptation easier. A small electronics manufacturer in Texas makes a different adaptation. They were sourcing components from China and selling finished products to U.S. customers. The currency disruption makes the math difficult. So they pivot. They start sourcing from Taiwan, South Korea, and domestic suppliers. Costs are 18% higher, but payment settles in dollars. They raise prices 12% and absorb the rest. Some customers leave, but most stay, because reliability has value. Within 3 months, they're profitable again, not at previous margins, but stable. An agricultural exporter in Iowa has the opposite experience. They sell soybeans to China, massive volumes, but now payment comes in yuan. They work with their bank to establish yuan accounts. Accept the currency risk. The math still works because Chinese demand is high enough to justify the complexity. They hire a currency risk manager, someone whose entire job is managing the exposure to yuan fluctuations. It's a new cost, but it's manageable. These are the success stories. Adaptation is possible, but it's not free, but not everyone can adapt. A small import business in Seattle specialized in Chinese manufactured consumer goods, kitchen gadgets, home decor, small electronics, low margins, high volume. The business model worked when payment settlement was simple and fast. Now payment takes 18-25 days instead of 3. Currency conversion costs 2.3% instead of 0.4%. And yuan volatility adds unpredictable risk. The owner runs the numbers. The margins that were already thin are now negative. She can't raise prices enough to cover costs without losing customers to competitors. She can't absorb costs without losing money on every transaction. Day 47, she closes the business. 8 employees laid off. A company that survived COVID couldn't survive currency disruption. Small retailers face similar math. A boutique clothing store in Portland that sourced inventory from Chinese manufacturers ain't make the yuan payment system work. They switched to domestic suppliers, but the inventory costs 50% more. They raise prices. Customer traffic drops 35%. 6 months later, they close. Not because of one catastrophic failure, because dozens of small frictions added up to an impossible business model. A logistics company that specialized in US-China shipping sees volume drop 28%. They lay off 190 workers, scale back operations. They survive, but smaller. Regular people make adjustments that collectively reshape consumption patterns. A family in Colorado used to buy electronics casually. New laptop when the old one slows down. Upgrade phones every 2 years. Replace the TV when a better one goes on sale. Now they're more careful. Laptops are 15% more expensive. Phones are 12% more expensive. TVs are 18% more expensive. Not unaffordable, just expensive enough to make them pause. The laptop, that's a bit slow. They'll keep it another year. The phone that's 2 generations old still works. The TV, fine for now. Multiply that hesitation across millions of households, and consumer electronics sales drop 11%. Best Buy sees revenue decline. They reduce orders from suppliers. Suppliers reduce production. Workers get fewer hours. It's not a crisis, it's a contraction, gradual but real. Restaurants that specialized in Asian fusion cuisine face different challenges. Certain ingredients that came from China are now harder to source or more expensive. They adapt menus. Substitute ingredients. Some customers notice, some don't. A restaurant in Nashville that built its identity around specific Sichuan ingredients changes the menu entirely. New focus on locally sourced Southern cuisine. It's not what they wanted to do, but it's what works. Customer reviews are mixed. It's good, but it's not what I came here for. Traffic drops 22%. The restaurant survives. But it's a different business now. Community responses emerge in unexpected places. A neighborhood buying club in Portland organizes to bulk purchase goods before prices rise further. 40 households pool resources, buy directly from importers instead of retail. It saves money. But more importantly, it creates resilience through community coordination. Networks that didn't exist before the scenario now provide economic function. These adaptations don't reverse the costs, but they distribute them differently. Day 90. A pattern has stabilized. This is what the economy looks like now. US-China trade volume is running at 68% of pre-scenario levels, not because of prohibitions, because the friction of payment settlement has reduced flow. Some trade shifted to yuan, some trade shifted to other countries, some trade just stopped. Currency markets have found a new equilibrium. The dollar is 5.4% weaker against major currencies than before. Treasury yields are elevated but stable. Mortgage rates are 1.1% higher than 3 months ago. Consumer prices on Chinese manufactured goods are 11-14% higher. Electronics, clothing, toys, small appliances, all more expensive, not catastrophically, but noticeably. American workers are feeling it unevenly. Manufacturing jobs in sectors competing with Chinese imports have actually increased slightly. The weaker dollar makes U.S. products more competitive, but jobs in import-dependent sectors have declined. The net effect is roughly 140,000 fewer jobs across the economy. That number doesn't make headlines, but it's 140,000 people whose employment situation changed because of currency policy most of them don't understand. A college student in Arizona walks through Target and notices prices seem higher than she remembers. She doesn't connect it to yuan policy. She just adjusts her budget, buys less, chooses generic brands more often. To her, this is just what the economy feels like now. She doesn't have before as a clear reference point. That's the moment when disruption becomes normal. Day 120. Negotiations between U.S. and Chinese financial authorities produce a framework agreement, not a resolution. A framework. China continues to accept yuan as primary settlement currency. But they establish a currency exchange mechanism that allows dollar conversion at standardized rates. Payment settlement time decreases from 18 days to 6 days. It's not ideal, but it's functional. Trade volume begins increasing again, slowly. Companies that pulled back start cautiously re-engaging. The payment mechanism isn't as smooth as before, but it works. By month 6, US-China trade is running at 79% of original levels. The remaining 21%, some of it shifted permanently to other countries, some of it shifted to domestic production, some of it just disappeared as consumption decreased. But some things have changed permanently. American companies make strategic decisions about supply chain architecture. China remains important, but no longer exclusively critical. Corporations are building what they call geographic diversification. This means $340 billion in investment over 5 years into manufacturing capacity in Mexico, Vietnam, India, and the United States. It means 280,000 new manufacturing jobs in the US. But it also means consumer goods cost more. The efficiency of concentrated Chinese manufacturing is being replaced by the resilience of distributed production. Every American household is paying for this. The average cost increase across all consumer goods, roughly 6 or 8%. For a median household, that's about $3,400 annually. Financial institutions maintain yuan trading capabilities they built during the crisis. The dollar remains the dominant global reserve currency, but it's no longer the only one. When usage in international trade settles at about 22% of global volume, up from 4% before the scenario. That doesn't sound dramatic, but it represents a fundamental shift. The dollar's monopoly on reserve currency status has ended, not suddenly, gradually, but irreversibly. Banks stock higher dollar liquidity reserves. The Federal Reserve maintains elevated readiness for currency market intervention. These are invisible infrastructures, but they cost money. About $28 billion annually across the financial system in increased reserve requirements and hedging costs. Pension funds and endowments recalculate their risk models. Treasury bonds are still safe, but they're not quite as safe as they were. Expected returns decreased by 0.4, 0.6%. That sounds small. Over 30 years, it compounds to a 12-15% reduction in retirement savings growth. A 28-year-old starting her first job contributes to her 401k and doesn't know that the currency scenario that happened this year just reduced her expected retirement account value at age 65 by roughly $47,000. She can't know. The effect is too distant and too diffused. The scenario is over, but its consequences unfold across decades. But there's a cost that doesn't appear in any economic report: confidence. The invisible architecture that makes people believe the systems they depend on will continue functioning, that the dollar will maintain value, that supply chains will deliver goods, that prices will be predictable. Some of that confidence was spent during these 120 days. A bond trader in New York still checks Treasury yields first thing every morning with more anxiety than he used to, even though they've stabilized. A small business owner in Ohio who survived the payment disruptions now keeps larger cash reserves. Even though settlement systems are working again, the memory of uncertainty creates permanent caution. A family in Texas who watched grocery prices increase still comparison shops more carefully than before, even though prices have stabilized. The experience of volatility creates lasting behavior change. A university endowment manager who saw portfolio values drop now holds more diverse assets, less concentrated in any single currency or country. The risk that materialized once is now permanently priced into decision-making. Economists call this expectations adjustment. Behavioral psychology calls it learned wariness. Whatever the term, it means people and institutions operate slightly more cautiously than before. The aggregate effect is subtle but real. An economy operating with elevated caution grows more slowly, not dramatically, but measurably. Over a decade, this caution costs roughly 0.3% of annual GDP growth. Compounded, that's $2.1 trillion in economic output that won't exist because of behavior changes that started during a currency scenario that lasted 120 days. Zoom out from the 4 months. What does this simulation actually show? It reveals something most people understand abstractly but rarely consider concretely. Global finance is not just money moving between countries. It's trust, infrastructure, and habit operating at scale. The dollar's role as the global reserve currency isn't guaranteed by law or force. It's maintained by network effects. Everyone uses dollars. because everyone uses dollars, but network effects can shift. And when they shift, the consequences cascade through layers of economic activity most people never see. This isn't about blaming China's decision or America's policy response. It's about understanding the architecture of a financial system where efficiency was prioritized over redundancy for decades that creates fragility in specific, predictable ways. The scenario is hypothetical, but the mechanisms are real. The trade dependencies are real. The payment settlement systems are real. The Treasury bond markets are real. The pension funds are real. The only hypothetical part was the trigger. Remember that Reuters notification at 9:47 a.m.? In this simulation, the gap between normal financial operations and elevated mortgage rates affecting millions was about 11 days, not instant, but fast enough that the systems designed to absorb shocks couldn't fully prevent spillover effects. The scenario was a simulation, but the settlement systems it stressed are the same ones processing transactions right now. The currency markets it disrupted are functioning today. The pension funds it affected are managing your retirement savings. The only difference between simulation and reality is that the trigger hasn't happened yet. The real question this simulation raises isn't whether China will refuse dollars. It's how many other single points of leverage exist in global financial architecture that could create similar cascades, and how quickly stable becomes turbulent when one of them gets activated. We built a system optimized for efficiency and volume. We got efficiency and volume. We also got leverage points that can transmit shocks at the speed of electronic markets. Whether that's an acceptable trade-off depends on how you value system resilience versus transaction cost. There's no objectively correct answer. But after watching this simulation, you probably have a more informed opinion about what the global financial system can absorb and what it can't. The distance between monetary stability and currency crisis might be shorter than a single policy announcement. If this type of economic simulation interests you, the algorithm will show you similar scenarios. And here's the question I'll leave you with. If you saw that Reuters notification tomorrow morning, how many days would it take before you noticed something changed in your own financial life?